Listen carefully. I want you to put aside the daily price fluctuations, the financial headlines, and the endless noise that dominates the investment world. What I am about to discuss is not a routine market move. It is not another temporary surge that analysts will explain away with a few economic statistics in a short television segment. I am talking about a structural shift that develops over decades and reveals itself only when the underlying system reaches a point where adjustment can no longer be postponed. Most people are completely blind to what is forming. They believe the financial system operates on a stable foundation because that is what they have been conditioned to believe. They see stock markets functioning, banks operating normally, governments issuing debt, and central banks projecting confidence. From the surface, everything appears manageable. But history has proven again and again that appearances often hide the most important realities. The real question is not whether the current debt-driven system faces pressure. The real question is how much pressure has already accumulated beneath the surface. I am not talking about a minor correction. I am talking about a long-term debt cycle that has advanced into a stage where maintaining stability requires increasingly aggressive intervention. For years, governments around the world have expanded obligations faster than productive growth. Debt has grown, deficits have expanded, financial commitments have multiplied, yet the solution offered repeatedly has remained remarkably similar. More liquidity, more borrowing, more monetary accommodation, more attempts to push adjustment into the future. This is not speculation. This is the pattern that appears whenever debt growth begins to outpace the ability of the underlying economy to support it sustainably. Ray Dalio has spent decades studying these long-term cycles. His framework does not focus on daily volatility. It focuses on the progression of debt systems from healthy expansion into overextension and eventually into periods where confidence becomes the decisive variable. That distinction matters because confidence cannot be manufactured indefinitely. It can be supported, it can be encouraged, it can be protected temporarily, but once confidence begins to weaken, the effects spread far beyond financial markets. You need to understand what is happening. Most investors still assume asset prices are primarily reflections of economic strength. They believe rising markets indicate healthy foundations. Sometimes that is true, but in highly leveraged systems, prices often reflect liquidity conditions more than underlying stability. When liquidity remains abundant, imbalances stay hidden. When liquidity becomes less effective, those same imbalances begin to emerge. This never ends quietly. The transition rarely announces itself with a clear warning. It develops gradually while the majority remains focused on short-term events. Small distortions appear first. Traditional relationships between markets begin behaving differently. Economic signals become increasingly difficult to interpret. Policy responses become larger while producing smaller results. What once required limited intervention begins requiring massive intervention. That is the signal many people miss. They focus on symptoms while ignoring structure. Silver holders need to pay close attention to this distinction because silver occupies a position unlike most assets. It is not simply an industrial resource. It is not merely a commodity used in manufacturing. Silver carries a monetary history that stretches across centuries. Throughout periods of monetary instability, assets with recognized scarcity and historical monetary relevance have behaved very differently from conventional financial instruments. This is where the conversation becomes important. When people hear projections involving extraordinary silver valuations, their immediate reaction is disbelief. They assume such numbers represent excitement, exaggeration, or unrealistic optimism. But that reaction often comes from viewing the asset in isolation rather than examining the condition of the system used to measure its value. The unit of measurement matters. If the purchasing power of currency remains stable, asset valuations tend to remain anchored within familiar ranges. But when debt burdens expand, intervention intensifies, and monetary credibility begins facing pressure, valuation frameworks change. The issue is not simply whether silver becomes more valuable. The issue is whether the currency used to price silver maintains the same credibility over time. History has demonstrated this repeatedly. Major debt cycles do not conclude because policymakers suddenly discover a perfect solution. They conclude because accumulated imbalances eventually require adjustment. Sometimes that adjustment occurs through restructuring, sometimes through inflation, sometimes through currency depreciation, sometimes through combinations of all three. The mechanism varies, the outcome remains remarkably consistent. Financial claims become less certain while tangible assets become increasingly attractive. That is why silver deserves attention at this stage of the cycle. Not because of speculation, not because of hype, not because of emotional forecasts. Because capital behaves differently when confidence begins shifting. Most investors are still evaluating silver through the lens of recent years. They see periods of sideways movement and assume limited potential. They see volatility and assume uncertainty. They see underperformance relative to fashionable assets and conclude that silver lacks relevance. But compression should never be confused with weakness. In many cases, prolonged compression represents stored pressure. Markets often spend extended periods building conditions that are invisible to the majority. During those periods, interest fades, participation declines, conviction weakens, attention shifts elsewhere. Yet beneath the surface, structural forces continue developing. That is exactly why late-stage debt environments become so important, because by the time the majority recognizes what is happening, the adjustment phase is often already underway. I want you to think carefully about that. The largest financial transitions in history were rarely obvious at the beginning. They appeared gradual, they appeared manageable, they appeared temporary. Only later did participants realize they were witnessing the final stages of a much larger process. And today, many of the same conditions are beginning to align. Rising debt burdens, growing fiscal pressure, increasing dependence on intervention, persistent monetary expansion, and a growing gap between financial obligations and productive capacity. Those are not isolated developments, they are interconnected signals. Signals that suggest we may be entering one of the most important phases of the long-term debt cycle. Now you need to understand how these transitions actually begin. Most people assume major financial shifts start with dramatic headlines. They imagine a crisis announcement, a policy shock, or a sudden event that instantly changes investor behavior. But that is not how structural transitions usually unfold. The earliest stage is often almost invisible. The signals appear subtle. The movements appear isolated. The majority dismisses them because they do not yet fit the conventional narrative. That is precisely why so many investors fail to recognize turning points until they are already well underway. Listen carefully. Capital does not move randomly. It follows incentives, confidence, and perceived safety. During stable periods, money naturally flows toward the largest and most established areas of the financial system. Government debt attracts capital because it is viewed as secure. Large corporations attract capital because they appear durable. Traditional financial assets attract capital because confidence in the monetary system remains strong. But late-stage debt cycles gradually alter those incentives. As debt obligations expand and fiscal burdens grow heavier, policymakers face increasingly difficult choices. They can attempt to maintain restrictive conditions and risk economic contraction, or they can provide additional liquidity and risk weakening the purchasing power of currency. Neither option is painless. Neither option restores long-term balance immediately. That is where uncertainty begins, and uncertainty changes behavior. Investors start paying attention to factors they previously ignored. Instead of focusing exclusively on returns, they begin focusing on resilience. Instead of asking which asset can grow the fastest, they begin asking which asset can preserve value if monetary conditions become unstable. This shift is critical because once preservation becomes more important than performance, capital allocation starts changing, not dramatically at first, not all at once, but steadily, quietly, almost invisibly. A portfolio manager adjusts exposure slightly. A pension fund modifies risk assumptions. A large institution introduces additional allocations to tangible assets. A sovereign investor begins reconsidering long-term monetary exposure. Each individual adjustment appears insignificant. Collectively, they become powerful. This is where silver enters the conversation. Silver occupies a unique position because it benefits from two separate forces simultaneously. On one side, it possesses practical industrial utility. Modern technology relies heavily on silver. Electronics, renewable energy systems, medical applications, communications infrastructure, and numerous manufacturing processes depend on it. That demand creates a fundamental foundation. But silver possesses another characteristic that many investors underestimate: monetary memory. For thousands of years, silver functioned as a recognized store of value. Long before modern currencies existed, silver served as money across civilizations. That historical role does not disappear simply because financial systems evolve. During periods of confidence, its monetary identity remains in the background. During periods of stress, that identity becomes increasingly important. This distinction matters enormously because markets often reclassify assets during major transitions. An asset viewed primarily as a commodity can suddenly begin receiving attention as a monetary hedge. Once that reclassification starts, valuation frameworks change dramatically. Most people do not anticipate this. They assume demand patterns remain constant. History suggests otherwise. When confidence in financial systems weakens, investors frequently reassess what constitutes genuine security. They begin looking beyond paper claims and financial promises. They start favoring assets that possess scarcity, durability, and independence from monetary intervention. Silver satisfies all three conditions, and because the silver market remains relatively small compared with global financial capital, even modest reallocations can create outsized effects. This is something many investors fail to appreciate. Market size matters. The larger an asset class, the more capital it can absorb without significant price movement. Smaller markets behave differently. When meaningful amounts of capital begin flowing into constrained markets, prices adjust rapidly because supply cannot expand fast enough to meet demand. Silver sits directly within that dynamic. Production cannot be increased overnight. Mining projects require years of planning, development, financing, permitting, and construction. New supply enters the market slowly. Financial demand, however, can increase very quickly. That mismatch creates sensitivity, and sensitivity creates potential acceleration. Now combine that reality with the conditions described by Dalio's long-term debt cycle framework. Debt levels continue rising. Fiscal deficits continue expanding. Interest obligations continue consuming larger portions of government resources. Policymakers continue relying on intervention to stabilize financial conditions. Each intervention may provide temporary relief, but relief is not resolution. That is an important distinction. A system can remain functional while becoming progressively more dependent on support. In fact, that dependency often grows gradually enough that most participants fail to notice it, until suddenly they do. The turning point arrives when investors begin questioning whether future interventions will carry greater costs than benefits. Once that question emerges, confidence begins changing, and confidence drives capital. This is not about predicting panic, it is about understanding behavior. Financial markets are ultimately collections of decisions. Those decisions are heavily influenced by expectations regarding future purchasing power. If investors believe currency stability will remain intact, they continue operating normally. If they begin doubting that assumption, allocation patterns start evolving. That evolution can remain hidden for long periods, then recognition spreads. And when recognition spreads, the pace of change accelerates. This is why major repricing events often appear sudden, even though their foundations were built over many years. The buildup occurs quietly, the adjustment occurs rapidly. Most people focus on the adjustment because it is visible. Few focus on the buildup because it is difficult to see. But the buildup is where opportunity exists. Silver has spent years moving through periods of frustration and neglect. Many investors lost interest, many abandoned positions, many concluded that more exciting opportunities existed elsewhere. Yet long periods of neglect often create favorable conditions for future revaluation. Why? Because crowded markets rarely deliver extraordinary surprises, underowned markets do. And silver remains significantly underrepresented relative to the scale of potential monetary uncertainty developing globally. That is why the current environment deserves attention, not because a specific date guarantees change, not because a particular headline guarantees acceleration, but because structural conditions continue aligning in ways that historically preceded major shifts in capital behavior. The real story is not daily volatility. The real story is the growing tension between expanding debt obligations and the policies required to sustain them. That tension continues building, and when enough investors recognize its implications, the next phase of silver's story may begin far faster than most people currently imagine. Now I want you to focus on the phase that changes everything. because there comes a point in every major debt cycle where pressure that has been building quietly for years can no longer remain hidden. The system reaches a stage where intervention becomes expected rather than exceptional. Financial markets begin relying on support as a normal condition. Investors assume liquidity will always arrive when needed. Policymakers become increasingly responsible for maintaining stability. That assumption works until confidence begins to weaken, and once confidence starts weakening, market behavior changes rapidly. Listen carefully. Markets do not move because everyone suddenly agrees on a new reality. Markets move because enough participants begin acting on the possibility that the old reality is changing. That difference is extremely important. By the time consensus forms, much of the adjustment has already occurred. The earliest stage of repricing is rarely recognized for what it truly is. Most observers dismiss it as temporary volatility. Analysts attribute it to isolated events. Commentators explain it through short-term narratives. Investors convince themselves conditions will soon return to normal. But normality becomes difficult to maintain when structural pressures continue accumulating. This never ends quietly. The final stages of major debt cycles often involve a conflict between economic reality and policy necessity. Authorities want stability. Markets want confidence. Citizens want purchasing power. Governments want flexibility. Yet these objectives become increasingly difficult to satisfy simultaneously when debt burdens reach extreme levels. That is where adjustment begins, not necessarily through collapse, not necessarily through crisis, but through repricing. Through shifting expectations, through changing perceptions regarding what constitutes safety. Once investors begin questioning the long-term purchasing power of currency, their behavior evolves. They start placing greater emphasis on scarcity. They begin favoring assets that cannot be created through policy decisions. They become increasingly concerned with preservation rather than speculation. That transition creates powerful feedback loops. At first, only a relatively small number of participants recognize the shift. Then prices begin responding. Those price movements attract attention. Attention attracts additional capital. Additional capital reinforces the original move. The process becomes self-reinforcing. This is why major monetary transitions often appear sudden to those who are not watching the underlying structure. The buildup may require years. The recognition phase may require months. The repricing phase can require surprisingly little time. History demonstrates this repeatedly. Large adjustments rarely unfold in perfectly smooth patterns. Instead, they arrive through bursts of acceleration separated by periods of hesitation. Markets pause. Participants question the move. Skeptics emerge. Then another wave of recognition appears and prices adjust again. Silver is especially sensitive to this process. Its market size remains small relative to global capital pools. The amount of money invested in traditional financial assets vastly exceeds the amount invested in physical silver. That imbalance means silver does not require universal participation to experience substantial repricing. It requires flow. And flow follows confidence, or more accurately, the loss of confidence. When investors become concerned about debt sustainability, monetary stability, fiscal discipline, or currency purchasing power, they begin searching for alternatives. They do not need to abandon the entire financial system. They simply need to increase allocations toward assets perceived as more resilient. Even a modest shift can have significant consequences. That is what makes late-stage debt environments so important. The system becomes increasingly sensitive to changes in perception, and perception can change faster than fundamentals. Many people misunderstand this dynamic. They assume extreme asset movements require equally extreme physical shortages or dramatic economic transformations. In reality, financial markets often reprice based on changing expectations long before physical conditions fully reflect those expectations. The expectation itself becomes the catalyst. That is why confidence remains the central variable. Ray Dalio's debt cycle research repeatedly emphasizes the role confidence plays during periods of adjustment. Debt expansion can continue for surprisingly long periods when confidence remains intact. But once confidence begins eroding, maintaining stability becomes increasingly difficult and increasingly expensive. Each intervention requires more effort. Each solution generates additional consequences. Each delay increases future complexity. The system becomes trapped between undesirable choices, and that is exactly where many advanced economies appear to be moving today. You need to understand something else. The discussion surrounding potential silver valuations is often misunderstood because people focus on the number rather than the mechanism. The mechanism is what matters. A dramatic silver valuation does not necessarily require silver itself to become fundamentally different overnight. What changes is the relationship between scarce assets and the currency used to measure them. When monetary units lose purchasing power while tangible assets gain monetary relevance, valuation adjustments can become extraordinarily large. That is why historical monetary transitions often surprise people. They underestimate how quickly perceptions can change once confidence begins moving. Most investors will wait. They will seek confirmation. They will look for certainty. They will want official acknowledgement that conditions have changed. But certainty usually arrives after opportunity. That has always been the challenge. Positioning occurs before consensus. Recognition occurs before validation. Adjustment occurs before widespread understanding. And by the time financial media begins treating a transition as obvious, much of the movement has already taken place. That is why awareness matters, not prediction, not speculation, awareness. The exact trigger remains impossible to know with precision. It could involve sovereign debt stress. It could involve inflation reacceleration. It could involve currency instability. It could involve policy limitations becoming visible to markets. The trigger itself is secondary, the structure is primary, and today's structure shows expanding debt, persistent deficits, growing fiscal pressure, and increasing reliance on intervention to sustain equilibrium. Those conditions do not persist indefinitely. Eventually adjustment arrives, eventually capital responds, eventually confidence becomes the dominant factor. Silver holders should understand that this possibility is not rooted in excitement. It is rooted in the historical relationship between debt cycles, monetary credibility, scarcity, and capital preservation. The real question is not whether these forces exist. They already exist. The real question is how long they can continue building before recognition spreads broadly enough to alter behavior across the financial system. Because once that process begins, markets rarely wait for everyone to agree. They move. And when constraints force capital to seek protection, repricing becomes the mechanism through which the system adjusts itself. That is the stage serious investors should be watching now. Not because the future is guaranteed, but because the structural pressures are becoming increasingly difficult to ignore.